I think the price action this year was a little bit on the disappointing side. I didn't like to give price targets, but when I was pressed for one, I said, I'd like to see 150. We only got up to 126 or so. So a little bit on the disappointing side. But I don't think the 4-year cycle is relevant in the sense that, just because it didn't hit certain targets this year, it means that people have to wait another couple of years for the next bull run. I think we're in more liquidity-driven cycles now, as well as these kind of distribution cycles that it goes through. We also, of course, this summer went through a levered treasury company, a little bit of a bubble cycle there that I think had to be kind of worked away. And that kind of took away some of the buying power that would have gone maybe directly into Bitcoin. If instead went into like inflated MNAVs of these Bitcoin treasury companies, that literally could have been the difference between 126K Bitcoin and 150 Bitcoin or more.
Whether Bitcoin and fiat currencies can coexist depends largely on time horizon and Bitcoin's ultimate success. Historically, gold and fiat currencies have coexisted for many decades. Gold served as a neutral hard asset outside the financial system, while fiat currencies dominated day-to-day economic activity. Bitcoin, however, introduces something new. It can be thought of as a faster, harder version of gold, one that moves at the speed of the internet and does not rely on physical custody or centralized settlement. As long as Bitcoin remains decentralized, secure, and resistant to debasement, it represents a fundamentally different monetary rail. Over long periods of time, strong currencies tend to crowd out weaker ones. Just as the US dollar has crowded out many developing market currencies, a sufficiently large and trusted Bitcoin network could, in theory, begin to crowd out even the dollar itself. However, this is not a near-term scenario. The scale difference today is enormous.
So Jeff Booth says that fiat and Bitcoin cannot exist long-term on the same rails. And he says that leaders like Michael Saylor will eventually need to choose their rail. Do you agree with this?
Well, yeah, I think it depends on time horizon. And it depends on how successful Bitcoin is. Gold and fiat have been able to coexist for many decades. Bitcoin is kind of a faster, harder gold, as long as Jeff Booth would say, as long as it remains decentralized and secure, then it's basically kind of the apex predator of monies. And kind of like how dollars can crowd out developing market currencies, Bitcoin can eventually crowd out the dollar. We're talking, orders of magnitude difference here. So Bitcoin, depending on price action, something like a $2 trillion network. You're up against a minimum tens of trillions network, but really when you include all the bond markets and everything, it's more like a hundreds of trillions network. These ledgers, these powers, have the ability to tax other assets. They have the ability to declare things legal tender. They can put pressure on liquidity of systems, so they might not be able to, harm the asset itself, like something like gold or Bitcoin, but they can say, well, if you own it, we're going to do our best to surveil that fact and tax it and slow it down and add frictions where we can. And so I think it's a very long-term process for something like Bitcoin to 10x or 30x and start kind of being at the scale that would be like a completely viable power compared to the US and China and these really the biggest currency blocks in the world. But yeah, if it's able to kind of get super big, at the same time as you have kind of these long-term fiscal deficit issues really start to increasingly have their problems, and countries have to take more overt actions to try to protect their currency, things like you see in developing countries, capital controls and yield curve control and kind of this kind of yield suppression that happens. And it kind of, the mask comes off and more people flee to those assets. It can become kind of like there's two separate worlds there. And there's one that's kind of decentralized and resistant to debasement. The other one is centralized and increasingly rapidly debasing. I guess my view is that it probably would take quite a while if we reach that phase. And Bitcoin has to be tested in pretty much every way. It's already been tested by the flurry of altcoins. It's always tested by just the long-term risk of quantum and whatever kind of fears people have around the technical sustainability of it. Right now we're obviously seeing discussions around non-monetary data in the blockchain and what, if anything, should be done about that. So it has to kind of go through almost every test imaginable. Governments have tried to ban it, and in some cases pulled the ban back, or the government's own like legal system. Sometimes you have independent courts, and there's kind of money will come in and try to challenge certain bans. And it's this long-term thing that has to go through for decades to test itself to be super viable and resilient, and then grow large enough to challenge some of these really big systems.
And so is that one reason why you continue to invest in gold, silver, and like you mentioned, the stock market, potentially AI plays, and of course, Bitcoin? And what would your portfolio, general percentage recommendations be?
Well, it would depend on the investor, right? So someone who's 25, I'd have different kind of suggestions compared to someone who's 75. It also depends on what their convictions are. If someone's curious about Bitcoin, that's different than someone who's read 10 Bitcoin books and can answer tons of trivia about the thing and has conviction on it, right? So I wouldn't say they should have equal percentages of the asset. Also, people have kind of they have expenses. I mean, there's something, there's like a dozen people that are kind of one way or another reliant on my income and my support in many ways. And so, having like 85% drawdowns of the entire net worth at this phase wouldn't really be warranted. So yeah, and also I'm comfortable with equities. I'm pressing over the long term, and I've of course strongly added Bitcoin since I became interested in it. And for me, partially through just sheer appreciation. So Bitcoin's become a very large percentage. Kind of the initial years that I got interested, I put most of my cash flow toward it, and then when it goes up, 10x or more, that becomes a very big percentage of the net worth. And I never sell cold storage Bitcoin. And so generally speaking, my model portfolios that I kind of just put out for kind of broad, people can look at them and things like that, I put something like a 5 to 10% Bitcoin allocation. And of course, that's saying, okay, many people have a 60-40 portfolio. And it's like, okay, how can we make this less bad? Right, primarily the bond component. So it's like, well, you can put some of the bond component into gold, and gold has absolutely crushed bonds over the past 5, 6, 7 years. And you can put some of the equity component, the more volatile component, into Bitcoin. Bitcoin has beaten, other than maybe NVIDIA, Bitcoin has beaten most equities over this time. And by having some degree of diversification, your portfolio is more likely to go up most years. So, I mean, since like the peak of Bitcoin in 2021, gold has outperformed Bitcoin, kind of surprisingly, for like a 4-year stretch or so. And so having a little bit of both can help. Now, for my kind of personal allocation, it's much higher than 5 to 10%. Again, partially just because of sheer appreciation and never rebalancing. So it really much depends on the person and their conviction, and their what their needs are, their volatility tolerance. But generally speaking, it's a combination of diversification, but then kind of leaning in when you're convicted about something. And for me, that's Bitcoin. That's been precious metals, and then to some extent, it's been certain equities when I want a lower volatility ballast or income from those investments.
From an investment perspective, asset allocation depends heavily on age, income stability, financial responsibilities, and conviction. A younger investor with fewer obligations and high conviction may tolerate far more volatility than someone later in life who supports a family or relies on portfolio income. For most investors, Bitcoin does not need to be an all-or-nothing decision. In model portfolios designed for broad applicability, a Bitcoin allocation in the range of 5 to 10% can materially improve risk-adjusted returns without dominating portfolio volatility. This is especially relevant when viewed through the lens of a traditional 60-40 portfolio, where bonds have struggled due to inflation and rising interest rates.
So I think the 4-year cycle doesn't really make sense anymore, in the sense that it used to really matter because the new supply growth was significant, and so cutting that new supply growth in half was a really big event. And so it kind of gave us a natural 4-year cycle. Now, the supply growth is so low that it doesn't really change a ton. And the much bigger force is, if you raise the price, you get existing holders to sell, or some of them. There are people that bought 5, 10, 15 years ago that many of them have families now, or many of them are very wealthy in Bitcoin terms. They might want to upgrade their consumption. Some of them might want to diversify. Instead of having 95% of their net worth in Bitcoin, maybe they say, well, I'll go down to 70%. So you get this kind of unlocking of older coins that naturally happens when you have a really big price jump. And so it's kind of going through its distribution phase. I think the price action this year was a little bit on the disappointing side. I didn't like to give price targets, but when I was pressed for one, I said, I'd like to see 150. We only got up to 126 or so. So a little bit on the disappointing side. But I don't think the 4-year cycle is relevant in the sense that, just because it didn't hit certain targets this year, it means that people have to wait another couple of years for the next bull run. I think we're in more liquidity-driven cycles now, as well as these kind of distribution cycles that it goes through. We also, of course, this summer went through a levered treasury company, a little bit of a bubble cycle there that I think had to be kind of worked away. And that kind of, took away some of the buying power that would have gone maybe directly into Bitcoin. If instead went into like inflated MNAVs of these Bitcoin treasury companies, that literally could have been the difference between, 126K Bitcoin and 150 Bitcoin or more. But that's another cycle, just like anything else. I think going forward, you have to kind of take each month, each year for what it is, rather than assume that you're kind of owed a bull market just because it's that part of the cycle. You're owed a bear market just because it's that part of the cycle. And I think that's yet another narrative that Bitcoin has to kind of shake away, and that it over time will shake away.
What stands out to you as Bitcoin's greatest strengths in fixing broken money?
Well, I think the main one, and I catalog this a lot in Broken Money, is that for centuries, almost every technological innovation we had on money further centralized it. Every friction that existed, they'd solve it with another centralized layer. So if we wanted to send money, we would say, well, we'll both have a bank, we'll have an account at this banker, and we can just tell them to update our ledger, and occasionally we can withdraw or deposit, but instead of doing that every time, we can just tell them update the ledger. If we are in different, if we're further out, or if we use different banks in different countries, we can have a series of intermediate layers. You can have bigger banks to connect those other banks. You can have central banks connect them. You can have the biggest central bank of all kind of connect the other central banks, and you basically just build this nested series of centralized ledgers, which is super efficient. But then with a stroke of a pen, the people that run the ledger can default on you. They can seize your funds. They can, do all that stuff. And basically, a lot of this was the fact that, what we used as money, gold and silver, as kind of durable as they might be, they're slow. Yeah. And so as we kind of entered the telecommunications age, starting with the telegraph and going from there over the past 150 plus years, we've had to kind of find ways to abstract it, move around quicker on these centralized rails. What Bitcoin represents is a way to kind of move final value without centralization. So it's kind of the first monetary technology that doesn't just kind of build another layer of centralization on what we already have. It kind of runs in parallel from it, kind of fixes the root layer itself, and gives a whole nother path. And of course, when it's super early, it has to be tested, see if it even works over a handful of years. Then you have to see, can it be attacked? Can it be banned? Can it, how robust is it? And now that it's 17 years and almost 17 years and going, it just kind of keeps I think surprising to the upside. What's powerful is that it's just a fundamentally new way of kind of stripping out the importance of the middleman. I don't think it removes all middlemen everywhere, in the sense that it's not something that kind of on one layer scales to everyone. But what it does is it takes the central bank itself, decentralizes that basically. You have kind of gold combined with its own settlement rails, in a sense, digital gold. And then on top of that, it's this open source layer that anyone can build on. They can build L2s, they can build, if they want, custodial situations, anything in between. And people can kind of choose their own layer that makes sense for their specific purpose. Whereas in the current fiat system, you don't get to choose. You don't get access to the central layer. You only get access to the layer 2 and above. And it's a permissioned, centralized, debasing system. So that's basically what's powerful. It's something that is, has lower supply growth than gold and moves as fast or faster than fiat. And so that's a powerful combination.
And when you talk about Bitcoin in that way, you're talking about Bitcoin in self-custody.
Yes. Yeah. And I mean, I think it kind of like how I've used this analogy before, that when the car kind of got mass produced, it became the symbol of freedom. that you could go anywhere. And some people are like they can kind of practically build their own car from scratch. They can fix their car. They know how their car works. Other people are they're more hands off. They might just buy a car and bring it to mechanics sometimes. They might even just lease a car. They don't have their own car. And so people can kind of choose their own adventure for how hands-on they want to be with that, with home ownership, with other things. I think Bitcoin's kind of like that, where it gives the option where people can self-custody and move around their own money without kind of a centralized layer. I think many people, they want reversible transactions, or they don't want to have their entire net worth, stored on seat plates somewhere. So they do want to trust a custodian, or at least they have the option to say, okay, I'll custody half myself and I'll leave half in this other environment if I trust them. I think the main thing is it opens up the option so that, again, people can choose the whole stack itself. Going back to Hal Finney and Nick Szabo and kind of the early stages of Bitcoin, a lot of them would kind of view that, things have to be built on top of Bitcoin, some of which are custodial, some of which are not. But basically, for scaling or privacy purposes, there are benefits to these other parts of the network. But I think the key thing is choice, that people can kind of choose whatever layer, whatever solution gives them the best mix that they're looking for in terms of either self-custody or speed or privacy, different trade-offs at different parts of the stack. And there's not always one right answer for everyone. Even one person can choose multiple parts of the stack that make sense for them. They might have their savings in their own self-custody. They might have, then they might use a Chaumian mint for private, fast transactions. That's, got a custodial component for 1% of their Bitcoin, maybe. And different solutions for different purposes.
Bitcoin is not a short-term trade or a guaranteed outcome. It is a long-term experiment in monetary architecture, one that challenges centuries of centralized control and introduces a parallel path for value transfer and savings. Whether it ultimately reshapes the global system or simply exists alongside it, its impact is already undeniable. The future of money will not be decided in a single cycle or policy decision. It will unfold gradually, shaped by technology, fiscal realities, and human behavior. Understanding those forces, not chasing narratives, is what allows investors and individuals to navigate the transition thoughtfully.